Okay, so let's get started. So we're talking about what you need to know about mutual funds. So here's the thing. I've spent my whole career doing this. I wanted to be an investment, not a banker. I wanted to be a stockbroker, picking stocks. I fell into picking mutual funds and I loved it so much that I ended up staying in this field my whole career rather than going back to picking stocks. So I have spent quite a few years doing this. So today, what I can share is obviously a very small snippet of it. So don't think you can learn everything in one night. But if you like it, then we can continue the conversation and I can tell you what to do next. Okay, so let's also there's I have two websites, two handles, two everything. The reason is because I believe there are two levels of knowledge, especially in terms of things that I'm doing. One is for the layperson. So the money hunts is basically my idea of sharing knowledge with people who want to manage their own portfolio. Okay, so that's what we're going to talk about tonight. It's great. It's commendable that you were taking an evening out to actually learn about this, but I still think you are a lay person. Unless you tell me that you've done a finance degree and you want to be a professional in the industry, which is towards the end, I will touch on it. But there's a whole website and there's a whole sort of career that you can do. As I said, I've spent my whole career doing it. So that would be something we can touch upon. Okay, so let's get started. So simple thing. I've actually made enough videos on this and but I'm going to repeat this again. So basically, when you go and see a financial advisor or when you do your own investment, a lot of people tell you that you have so you obviously have a factual sort of situation. Your situation is different from mine, right? So how old you are, how much money you have currently, what your income is, what your responsibilities are, what your expenses are, what goal you want to have. All of that, your situation is going to be different from mine. So the factual information is going to be different. And also the risk profile. Now I'm putting in risk profile in inverted commas because it's a catch-all term that encompasses the capacity, the need to take risk, the capacity to take risk, and also things like risk appetite and risk tolerance. A lot of regulators and financial planners and a whole bunch of people see that as a psychological thing that somehow we are built in with some psychometric thing that if we are, for example, risk takers in our business or in our profession, somehow that translates to our investing as well. I do not believe that. And I have spoken to a lot of senior people who have psychology degrees, who have finance degrees, and I have yet to find anything definitive that such a thing as risk tolerance exists. Yet regulators around the world actually sort of presume it does. And therefore, when you see a financial advisor or you read the newspaper, you're given a questionnaire to say, here are some 6 to 10 questions, answer it, and we will tell you your risk profile. Like I said, I don't think that exists. I believe there is another concept in behavioral finance called mental accounting. I have been doing it all my life. It's worked fine. I've seen my parents do it. I've seen everyone around me do it. So what I want to suggest to you that you can use that to actually divide your money up into 3 buckets. That's what I put up on the screen. So instead of saying you have one risk profile, I'm saying that you take your money, all your wealth actually, and put it into 3 buckets. And those 3 buckets have 3 different risk profiles. Let me explain. So I think everyone has this one bucket, mental account that we say, do not ever lose this money bucket. What is that? That is basically if I had only 100 rupees today, what is the amount of money that I am just not willing to take a risk with? Okay. I think everyone has it. In my case, I hide it in multiple bank accounts. And I'll talk about where to invest. But the idea is that out of the 100, there's X amount. It could be 30%, 40%, 25%, whatever it is, that you need certainty. I've highlighted the term certainty. So you need to have certainty of meeting your basic lifestyle. and your time horizon is 1 to 2 years. Okay, so notice the time horizon and notice the word that I've used. The second bucket is I want a reasonably high probability of meeting my long-term goals. Okay. And usually my long-term goals are long-term. So it's usually if you are young, you want to buy a house, you want to get married, you want to travel around the world. If you are middle age already, you want your kids to have a good education. And every one of us wants to have a reasonably good lifestyle when they retire, usually in relation to how we live today. So notice the word high probability, which means it's an important goal for you to meet. Most of these goals, like I said, are long term. So again, I've put the time horizon and I've put the risk, the high probability. And then all of us also have this dream of wanting to get rich. So what is that? So that's the possibility of getting rich. So I've put that as the third bucket. Okay, so that is, so one bucket is certainty of meeting basic lifestyle. So in my case, what is the amount of money I need to be able to pay rent for my apartment and have some basic dal chawal roti type sort of lifestyle? Okay, high probability of meeting my retirement. How much money do I need to have to be able to have the same lifestyle when I retire and I'm not working, which by the way is right now. Okay, and the third one is I still I'm putting something, whether it's in my own business, whether it's in a portfolio, whether it's in a lottery ticket, something that allows the possibility of getting rich. The word is possibility. So all these three terms, certainty, high probability, and possibility, are basically terms from probability analysis, right? So it's but it's simple English version of it. And then there's a fourth bucket for when you are retired, which is basically when you want to retire, you convert your growth assets into income assets. So what I'm saying to you is that forget risk profile. I think you divide your money up into 3 buckets, and you can be low risk profile for one part of the bucket, which is in red, which I've called essentials foundation. You can be reasonably sort of high, reasonably medium market risk return, which is the blue, the growth pillars, which basically gives you a reasonably high certainty of meeting your goals. And the third one is the possibility, which is high risk, high return. So I'm saying to you that one person, I do not have a split personality. I'm just like a normal human being where I divide my money up into 3 and I have all 3 different risk profiles. So that's basically flying in the face of what you are told about risk profile. Okay, so that's the one concept that I'm sure there would be questions later on. I can take them. But that's what, when you go to see a financial advisor, that's what you need to do. Now, why is that important? Now, why did I do that? Because I think all you need to do is match the asset classes to these goals. Okay, so now the next question is, what are asset classes? So there's only 2 asset classes in financials, and then there's 2 in physical. The 2 financial asset classes are equity and debt. Simple. What you're doing in debt is you are giving your money to a business with the hope that the money will be given back to you at the end of the period. And in between, you are going to get a coupon, an interest rate. That's debt. When instead of wanting your capital back, you want to be a silent partner in the business, you are taking an equity stake. Okay, here you cannot ask your money back. You cannot ask for a fixed rate of interest rate. You cannot tell the business what to do. You are simply a silent partner. So the equity, the management, the CEO, and the team is who runs the business. So they're the only 2 ways of investing. Now, each of these 2 have sub-asset classes. I can call them sub-asset classes, or I can call them segments. I can call them categories. I can call them classifications. I can call them whatever I want, depending on who I am. So that's why in the middle, I've put this guy with the cool glasses on, the investment professional, people like me. And based on term, size, risk, liquidity, geography, I can call it a different asset class. Now, notice what I call something in India might be different to what I call something in Australia, which might be different in the US. So for example, debt. If debt is less than 12 months, it's called cash. The world over, it's called cash or liquid or money market. Okay, there are three terms basically for what is essentially the same thing, which is basically it's a treasury or government debt less than 12 months. Now, I'm saying government because that's your benchmark, but then there are obviously you can lend to a corporate as well, and that becomes a different sub asset class. If it's more than 12 months, it's called fixed interest. It may or may not be fixed interest. It might be floating rate, but it's still called fixed interest. Within that, there might be government, there might be corporate. Within corporate, there might be investment grade, which is sort of up to triple B, and there might be lower than triple B, depending on, obviously, these are credit ratings that I'm referring to, which credit rating agencies give you. And then less than triple B is called high yield, or it's called junk bonds. Now, all of these things put together are still debt. Why am I telling you this? Because depending on how far down the fund is going or the instrument is going, the risk return characteristic changes. So at a high level, there is one set of risk return assumptions, but then as you go deeper and deeper and deeper, it changes. Okay, so the risk changes and therefore the return changes. Same thing with equities. There's large cap, there's small cap. In my view, they're not sub-asset classes. They are simply segments. But around the world, large and small are divided up separately. But there's also geography, right? So in India, for example, we have a home bias, just like everybody else in the world. People tend to invest in their own markets and invest very little overseas. Now, if your home market happens to be the US, which is 50% of the world market, that's fine because you're only missing out on the rest 50% of the world. But if you happen to be in Australia or in India, we are less than 2% of the world market, which means we're missing out on the other 98%. Okay, that's not a good thing, especially if we are consuming things, especially now or as we grow up and or go into retirement. If we are consuming, whether we're buying iPhones or whatever the international MNC names are, if we're consuming international names, then you might also want to have a portfolio that's international. But everyone has a home bias, so that's an issue as well. So again, domestic equities and international equities are considered different. And then within international equities, there's developed markets and there are emerging markets. And again, these behave differently. So you start off with two asset classes, but then you go very, very quickly into these sub-asset classes. And the further down you go, the smaller they become. And therefore, their risk return is no longer similar to what the headline is. Now, commodities. The one that we all are aware of is gold. Gold is a special case of commodities. Okay, gold is really its own asset class because it's been around as a currency for thousands of years. So gold is its own asset class, but then everything else that is a commodity, which could be other metals, it could be silver, it could be iron, it could be aluminum, it could be all kinds of things. It could be soft metals, not soft metals, but soft commodities. It could be hard commodities. It could be food, it could be clothing and things like that. Everyone uses it. So there is a case that you'd want to have commodities in your portfolio. And then there's real estate, which again, everyone of us knows because we all want to buy our own houses. We also need to be aware of how every one of these things are priced. So real estate is just like any other asset. So debt, equity, commodities, real estate, all assets are priced in the same way, which is basically all you're doing is projecting cash flow into the future, discounting it back, and trying to figure out whether or not you're getting a reasonably high return for the risk you take. Okay, that's what asset classes are. 99% we all agree what they are. But like I said, depending on who you are, where you are, you may actually have a different definition. So when someone tells you this is a debt fund, then you might want to just check that is it government debt or do they also have corporate debt? In which case, do they have high yield or junk bonds in it? This is very, very relevant for when we're talking about some funds that have high risk, which we'll talk about in a second. Now, what is not an asset class? Mutual funds are not an asset class. Mutual funds are a product category. Okay, they're simply a unit trust structure, which is basically a wrapper. It's a legal structure where you are pooling your money with everybody else's, you're putting it into a trust account, and then you're hiring an AMC. An AMC then employs a fund manager. By the way, in global language, the fund manager is referring to the company, the AMC. In India, the fund manager refers to the person. It's a mistake I learned the very hard way when I first came to India. But anyway, the point is that it's your money sitting in a trust, and you are appointing an AMC who then employs fund managers, and then they buy stocks or bonds. Okay, that's the mutual fund. But you can also buy stocks directly. You can buy a PMS, which is a portfolio management service, which technically is not a legal structure. It's just a power of attorney contract that you're giving to the AMC, to a fund manager, to buy stocks on your behalf, held in your name. And then there's listed trusts, which is basically like mutual funds, but the whole trust is listed. Now, why would that happen? Mutual funds are open-ended trusts, which means that when you put money in, a new unit is created. So the unit price actually doesn't matter. Okay, so I have no idea why Indians are fascinated by the new fund offers, because unlike IPOs, IPO sort of happens because there's a limited number of stocks being issued and there's a price on it. But an NFO, it's not a limited number of units. The very next day after the NFO, they're going to issue new units. So an NFO does not make any sense whatsoever. So mutual funds tend to be open-ended, therefore NFOs don't make sense. But in some asset classes, there is a case for not being open-ended. Usually when the underlying portfolio of assets is illiquid, they actually decided to form listed trusts, which means they end up putting closed-ended funds and they list the whole fund on the stock exchange. So ETF, exchange traded fund, is basically an example of a mutual fund, a closed-ended mutual fund, that the whole thing is listed on the stock market. But there are other examples. There's things like REITs coming up in India, which is real estate investment trusts, where the underlying assets are buildings, not residential, but commercial buildings. So it could be an office building, it could be a shopping mall, it could be a warehouse, it could be an INVIT, which means an infrastructure trust, which could be a toll road or a port or something like that, or an airport. So there's a case for listed trusts as well. Now, all of whether you buy direct PMS, mutual fund, or listed, technically it should not matter. The reason I say that is in the short term, it could matter depending on which one of these four you are in. For example, if you are in an ETF, say you are in a bond ETF, okay? Because the ETF is listed on the stock exchange, if the stock market goes down, that bond ETF will also go down in the short term for a day or two or three. But very quickly, the value will revert to its underlying asset. Same thing with REITs, same thing with INVITs. So even though real estate and infrastructure and bonds are different asset classes, by putting them in the fund structure and putting them on the stock exchange, you are affected by the short-term movements of the stock market. Okay, but long-term, it doesn't matter. Now, why are there different cases? One, because in direct, for example, you can do it yourself. You can buy the stocks or bonds yourself, or you can buy the properties yourself, and you'll be fine. It's free. If you have the time, inclination, or the skill to do it, be my guest, you should do it. Okay. In a mutual fund, as I said, you are giving it to a fund manager, and he or she is supposed to be doing a better job. ETFs. Now, ETFs can be active or passive. By and large, most of the ETFs in the world are passive. So when I'm referring to ETFs, I mean passive ETFs, unless I say differently. So passive ETFs are cheap because passive mutual funds, all they're doing is tracking the market index. So they are actually very, very cheap. They are less than 0.1%. But then there's no alpha. Now, what do I mean by alpha? I'll come back to it. But let me just sort of finish the loop in terms of asset allocation. So when I said earlier, you divide your money up into these 3 or 4 buckets, that is your wealth allocation. And all you have to do is pick some funds in that asset class that match the time horizon and put it in the same bucket in the bucket that matches a time horizon. So what do I mean by that? So like I said to you, Essentials Foundation is your safe bucket. This is the money that you do not want to lose. So what do? You basically buy cash mutual funds or money market mutual funds because the time horizon is less than a year. Okay, so Essentials Foundation is the money that you need to be able to get your hand on it very, very quickly. So cash mutual funds or short-term fixed interest funds or fixed deposits, they are equivalent fixed deposits. So basically, these are the ones that you put into your Essentials Foundation. When your horizon is longer in the growth pillars, so for example, your own education or your kids' education or your retirement, you have a long runway. Because you have a long runway, the best things to invest in are equity mutual funds. Why? Because on average, over 5 to 7 years, any rolling period over 5 to 7 years, they tend to make money. So you have a reasonably high probability of outperforming inflation and bonds and real estate, so long as your horizon is sort of 7 years plus. So just to be safe, I'd say 10 years, 7 years. Anything less than 5 years, you start switching from a pure equity fund portfolio to maybe a growth portfolio, which has, say, 80% equities and 20% bonds, things like that, or has some real estate or something else in it. But so the further away your horizon, especially, for example, all you're doing is building wealth for the long term, then you simply buy equity funds and put it in your bottom drawer and forget about it. What about your fund money? Now, fund money is high risk, high return. Mutual funds, I have not known anyone to get rich, like really rich on a mutual fund. So mutual funds were not designed to be your high risk, high return. Having said that, small cap funds are definitely one that you could buy for the high risk, high return. And if you go further down the spectrum, there are things like venture capital, which is not in mutual fund space, but is in the AIF space or the alternative investment fund space. So venture cap and small cap are basically similar things. These are small companies. So basically what was a venture capital funded company, say Nika, until last week, it was venture. And then this week, it's going to become, I don't know what the valuation, I haven't checked what the market cap will be, but it's going to be obviously listed. So it might start life as a small cap stock. My point is the risk return of those funds are very similar. So one is just unlisted, one is listed. Only when you're ready to retire should you bother about income producing funds. Okay. Until then, you do not want income. You only want growth. When you're retiring, close to retiring, that's when you want to convert your growth funds, so equity funds, into bond funds, or I would say more than bond funds, I would call them income funds. And income funds have more than just bonds. They tend to have REITs. So REITs are what? These are listed funds that have income producing real estate. The other thing, by the way, notice that depending on where you are, real estate isn't actually in 3 out of the 4. In fact, it could be in 3 out of the 4 buckets. So your home goes into your Essentials Foundation, a income producing property. So one that where you are in a good growth area, that is considered part of the freedom slab or the income generating assets. And then if you buy a piece of land that you think will be rezoned, or you know something that nobody else knows, or things like that, that's land, that's speculative. So even real estate, even the same asset class, depending on what kind of real estate it is, it could be put into one of 3 buckets. But it is still, technically, all 3 of them are highly risky because they're only one piece of real estate, unlike REIT portfolios. So hopefully, big picture, I mean, it should be obvious, but I didn't say it, so let me say it now. Which asset class you put your money into, or what proportion you put into which asset class, is more important than picking which fund. And therefore, the first thing you need to do is have your asset allocation or wealth allocation in order. And my suggestion is use this house framework. It's just one framework. Use the house framework to do that. The split between these 3 will vary depending on your own situation. Now, The next question is, I parked it, but let me address it now. So one thing is that past performance is not a good indicator of future performance. You've, I'm sure, heard this thousands of times. What does it mean? It actually means on both levels, on an absolute return basis as well as relative return basis. So what do I mean? So when, for example, someone says, oh, this fund did 20% last year. Okay. So how much of that is absolute and how much of that is relative? So what I mean by that is, what did the market do? So if it is happens to be a large cap fund, what did the large cap index do? Okay, which is equities, which is proxy for equities as an asset class. Okay, so what did equities do? So say, for example, equities did 15% and this particular fund did 20%. I'm saying to you that the fact that equities did, okay, 15 is a low for this year. Say last year, I don't know what the number is, but say the last year it was 30%. Just because equities did 30% last year, does that mean equities will also do 30% next year? No. In fact, it never does. So when people say equities on average do X%, it could be, say, 12%, then in any given year, it could be way above or way below that. On the long sort of average, it on the in the long term, it averages out. But in any given year, it could be much higher or much lower. That's what the standard deviation is. So usually when they say equities can do 12%, but in India, the standard deviation is about 25%. That means 67% of the times, or 2/3 of the times, it could be 15% average plus or minus 25%. Does that make sense? That's one standard deviation away. If you want to be 98% sure, it is 2 standard deviation. So you want to be 25 plus 25. So that's how big or how volatile Indian equities can be. Okay, that's what I need you to remember, that that's why showing last year's or the last 3 years performance even, or the last 10 years performance even, is not good enough, because the asset class may be far away from their long-term average. And then the next thing is that even say, for example, the market did 30% and your fund, they did 35. Okay, does that mean that they will keep outperforming the market by 5%? And the answer to that is also no. Okay, just because they outperformed by 5% in 1 year does not mean they will keep doing it for the rest of their life. In fact, why not? And both these things matter. One is because the last 30 years, I'm sure, I don't know what the average age is today, but the last 30 years, inflation has only been coming down. My whole career, inflation has only been coming down. When I was a kid in the 80s, inflation was very, very high. It used to be way over 10%. Now it's sub 5 on average. So what does that mean? Remember I told you that all assets are valued on a DCF basis. When the discount rate has been coming down, you get a one-off boost to the asset values. The opposite is also true. That means if discount rate is going up, if interest rates are going up, values come down. Okay, so it has a huge, profound effect on asset values, depending on what inflation does. And the next thing is that active mutual funds must have opportunities to add value and the skill to add value. And neither of those two things stay constant. They always, always keep changing. Now, let me jump into that in a second. Again, one more thing I'll add before I jump into active passive, which is basically taxes. So a lot of people say, oh, well, you know, what is the best mutual fund to buy to maximize my tax, or to minimize my tax, to maximize my tax efficiency? The answer obviously varies depending on market to market. In India, equity mutual funds are the best way to do it. But there's only a limit that you can do in terms of full tax deduction, which is under ATC. And there's these funds called ELSS, equity linked savings schemes, I think. They basically incentivize you to lock your money up for 3 years. Now, actually, take a step back. Why do you get tax incentives at all? At all, whether it's for an insurance product or a pension product or a Sukanya Samriddhi account. This is government's way of saying, here is your normal life, but we want to influence your behavior. So it's a carrot and stick approach. If you do something we don't like, we'll tax you more. Like if you buy cigarettes, we'll charge you a huge duty on it. But if you do something that we like, which is basically saving for your own retirement, then we will give you a tax advantage. So this is their way of nudging your behavior into doing the right thing. So the simplest way to defer tax is simply to buy and hold passive equity funds, because when you buy and hold, you are not triggering a tax event. If you're buying active funds, as we will discuss, then you will have to keep buying and changing it. So now let's jump into active passive. So until now, I've said what type, as in what asset class of funds must you buy? Buy some cash, buy some equity, and some small cap, and you're sorted. Okay. Now the question is how many, and should they be active or should they be passive? Well, it depends on three things. Can active outperform passive in that asset class? Can it? Question is then, does it? As in, do the active mutual funds actually outperform? Which is different from can. Can they outperform? Well, if any one person can outperform, if Warren Buffett can outperform, then it can be done. Do they? Aha. But are they as smart as Warren Buffett? Or do they have the same information as Warren Buffett? Or do they have whatever? The short answer is no, they don't. And therefore, while technically they can, they don't. Same thing in India. And can is actually a function of how many stocks there are, how many securities there are in that asset class, and what is the dispersion of returns between the best and the worst. What I mean by that is in India, for example, if there's 5,000 stocks, and actually imagine if there were only two stocks. If there were only two stocks and one of them did 10% last year and the other one did 9% last year. So even if you were a genius and you picked the one that did better, which is 10, how much would you have really outperformed by? The answer is not much, right? So now expand that to the whole asset class, which is equities. If all the stocks are not volatile and I'm moving in a small range, that means that the opportunity to add value is not much. So whether you buy the stock that did, like I said, say 10%, or the one that did 9%, or the one that did 11%, frankly, it won't really do much. For you to be able to really add value, you need the market to be volatile. You need the market to be going, one stock going up 300% or 1,000% and one stock going down by 80%. You need that volatility to be able to add value. So now in bonds, do you ever get that? Do you ever get a bond going up 1,000% and then down 90%? Of course you don't. So therefore, by definition, you have more opportunity to add value in equities than you have in bonds. Large cap, small cap, theory suggests that small cap should give you more opportunity because they are smaller stocks, therefore they're more volatile. Large caps, because they're more established businesses, their prices are covered so well by all these analysts around the world, therefore they shouldn't maybe be as volatile. That's the theory. Okay, we'll see whether they actually do that or not. And then the last thing I'd say is, can they add value? Do they add value? The last thing is, can I pick them? Can I pick the funds in advance? Not after the event, but in advance to be able to add value. Okay, that's what I'm going to focus on next. So what is fund selection? Fund selection relies on manager research, and manager research, there are two ways to do it. There is qualitative research and there is quantitative research. It's not the same as fundamental versus technical. Okay, it's not really the same. So qualitative is basically subjective. You are meeting the fund manager and the team, and you're saying, okay, can this manager add value? Now, here's the thing. You can meet them and they can be very impressive. They can be good looking. They can be tall. They can speak well. They have high IQ. They have been to Harvard. They can be all those things. And yet they might not be able to outperform. Amazingly, and the reason I say this is because my team tends to listen to the media interviews. And at the end of it, they say, when I ask them, after listening to this media interview, would you give them your money? 99% say yes. That person sounded really impressive. He really sounded like he knew what he was talking about. Well, turns out that's meaningless. Okay, every one of these people are usually well polished. Some of them have been trained in media training. They have taken acting classes, perhaps. I have. Maybe they have as well, and they can talk really well. Okay, that doesn't mean anything. So, um, and the other thing is that what you need to also assess is their style. So two people could be equally impressive, could equally be good, but they have completely different styles. So, for example, Warren Buffett, when he first started, had a value style because his tutor, Ben Graham, sort of believed in the value style, which was a cigar butt approach, which is basically if this company was worth 100, as in the assets on the books are worth 100 and it's selling right now for 80, let me buy it. But as he then got influenced by Charlie Munger, he changed his style to be much more buying businesses that have high moats. So Charlie Munger taught him that it's better to buy good businesses at reasonable valuation rather than terrible businesses or okay businesses with very cheap valuation. Because each time you buy cheap valuation, it tends to mean revert. You achieve your price, you sell it, and then you have to look for another stock and then another stock. So the turnover becomes actually quite high. So whatever the reason, the point is that they're different. People have different styles, and you need to be able to figure out when they will underperform and whether you can handle that underperformance. That's qualitative. You also need to meet the AMC CEO because the fund manager alone doesn't do anything. They also need a reasonable team. They need a Bloomberg terminal. They need access. They need all kinds of things. They need good IT systems. They need good risk management. They need all kinds of things, which the CEO or the management may or may not provide them. Okay, so you cannot judge just the funds management team or the investment team. You also need to judge the business. That's qualitative. Now, quantitative is performance and portfolio, two levels. Performance analysis is, did the fund perform as expected? And portfolio analysis is the portfolio showing style characteristics as expected. Now, what people end up doing is simply saying, did it do in the past? In fact, I've seen people do portfolio analysis by simply looking at the top 10 stocks of a fact sheet and saying, oh, this one has a good stock in it. Yeah, this must be a good fund manager. Or this person has bought this stock. I don't like this stock. Therefore, this must be a bad fund manager. Now, to me, that's stupid. I mean, what are you doing? Are you second guessing the fund manager? You're not supposed to be. You're actually hiring the fund manager because they're skilled and you are delegating that decision. You should not be second guessing them by saying what's in the portfolio. In fact, what you don't know is when they bought it, at what price they bought it, and when they will sell it. So I could have Infosys and you could have Infosys, but we bought it for very different reasons. In fund research and manager research, that matters. Why I bought it and when I'm going to sell it matters very much. But in a fact sheet, it doesn't tell you that. So to me, looking at a fact sheet and seeing that is absolutely useless. And then after you do, actually there was one, oh yeah, okay, sorry. I was remembering something. I will do that later. Anyway, so next thing is after you've decided on funds, you then also need to put together a portfolio of funds, right? So you need to decide whether you're going to go active or passive. But then are you going to have a core and satellite approach? Are you going to have like a core of passive and a satellite of active, or other way around? Would you have, again, in a company that I used to work for, we did not believe in core and satellite. We actually put together a portfolio of 3 to 4 high alpha funds. High alpha funds are very active funds. Okay, so they probably will cancel each other in terms of volatility, but the average outperformance ends up staying. So we used to construct a portfolio very differently to what was the accepted wisdom at that time. And how many funds? The more funds you add, the more the average will come down to the market return, which means you're paying a lot of fees to get market return, which you could have got for free or 0.1 or less than 0.1, right? So the more funds you add, the more you're actually reverting to the mean, and you are just making yourself more work by having to keep an eye on it. Next thing is, now who should you listen to for this fund research? So there's a whole bunch of people that the initials that you will come across. So on the top, I've put the license that they hold. And on the left, I've put the qualifications that they have. Okay, so most often you will see mutual fund distributors. That's the most common license. And you may see your chartered accountant giving advice, or someone who has a CFP or a CFP. Now, there's only a few thousand people who are qualified CFP or CFA. Chartered accountants, there's many more. But chartered accountants technically should not be giving you advice unless it's incidental. They're usually more likely to have a referral arrangement. The other thing that you'll see a lot more likely is an insurance agent. An insurance agent, there's many more, there's lakhs of them. And I think there's millions of them actually, especially an LIC agent. So technically they should be selling insurance products, but we've seen that a lot of them end up telling you it's like a mutual fund. Sometimes they drop the word like, and they simply say, yes, it's a mutual fund. And they basically end up selling you a ULIP. Okay, a ULIP is not a mutual fund. It may be like a mutual fund, but it's not a mutual fund. Okay, we can discuss another night why they're not as good as mutual funds. What ideally you should be doing is actually getting someone who's an RIA license, registered investment advisor. It's a different license from SEBI. That means that they cannot get commission. They should be only charging you a fee. And obviously, from an investment point of view, I'd say a qualification of CFA and a license of RIA is what you want ideally, which is the bottom right corner is what you want ideally. Okay. Now, all this time, I have assumed that you are actually a lay person. And that's basically what you need to know about picking mutual funds. Hopefully that makes sense. Now, I'm going to spend another 10 minutes just doing it up a notch, where I'm going to start using some technical jargon I'm assuming because you're following Aditya and the YouTube channel, you are interested in finance, and therefore you've come here for something more. So let me just take it up a little a notch. So now when I said to you, the market, which is the index, the passive funds track that index. Okay. Now, when I said to you that, for example, a fund did, remember I gave you the example of the fund did 30%, sorry, the fund did 35%, of which 30 came from the market and 5 came from alpha or excess return. The more realistic numbers are the equity market in India is likely to do more like 12, and the alpha is likely to be more like 2. So now notice that your 12% return can go to 14. They say post fees. They say that, okay? But that's their hope. That doesn't mean that they're actually going to do it. Some may end up doing slightly higher, say up to 5% alpha. But then by definition, some will end up doing lower. Okay, so I'm saying to you that most of the work is done by the market, and that is called beta. And you can get that very, very cheaply by buying index funds. What is the extra return? Colloquially, it's called alpha, but actually it's not alpha. It's called excess return. Alpha is actually something they have to adjust for the extra risk they take. And by risk, I mean extra compared to the market, extra thing. Now, here's the chart. So basically your return, which is that blue box at the top, gets divided up into what is the benchmark, which is a market cap weighted benchmark index, which is the light blue, and the active return, which is basically the excess return. But within that excess return, there's actually, again, 2 subcomponents. Okay. One is basically the returns that we expect to get because they took a certain tilt. What do I mean by that? So for example, when Warren Buffett or anybody else goes and buys value stocks or small cap stocks. Now, it turns out we've known for 50 years, more than 50 years, that value and small cap have outperformed the rest of the market. So by tilting towards what is well known by the industry, which is small cap and value, you're actually passing off as excess return, which is not something we skill. It's basically something that everyone in the market, a professional, knows. So if you're simply tilting towards these 2 things, then that is called smart beta, which is basically factors that everyone knows about. So what we do is we adjust for that. Once we adjust for that, what is left is what is called pure alpha. Okay. And that is what we should be paying for. Okay. And then pure alpha also is generated, which is why what we really want is in an active fund, we want pure alpha that is generated by bottom up stock selection. So adjusting for the value effect and the small cap effect and the momentum effect, there's a few other effects that people know about. Adjusting for all of that, if you still are able to add value, that is pure alpha. Okay, that's what we want. And that could be bottom up or top down, it doesn't matter, but that's what we really want. Okay, so this is for the finance professionals. If you're really interested, that's what you need to do. The other assumption is when I told you, okay, how to do manager research, the problem is I told you what needs to be done, which is qualitative and quantitative. The problem is that you can't do it. Why? Because you do not have the data and you do not have access to the fund managers or the CEOs. So very large institutional investors like pension funds and sovereign wealth funds actually pay my ex company, which is Mercer and Morningstar, and there's a whole bunch of other companies, Cambridge and Towers Watson, and a whole bunch of people. Okay, these are very well qualified and very well large companies, well stocked, well resourced companies that actually do this for a living. Okay, that's what I was doing, and we require a lot of data, a lot of analysis. No individual investor or even a financial advisor has the time or the inclination or the qualification to be able to do this. And then there's a whole other area called operational due diligence, which basically means going in and checking whether they have any operational risk. So when they say we do this, do they actually do it? In an interview, we might take their word for it. But in real life, we should not take their word for it. We should just go and check. And that's has been a reason for some blowups. So what actually happens in real life is that most financial advisors buy the research, this fund research, from a research house. So in India, there's Morningstar, there's Value Research, and then there's CRISIL and ICRA and so on. The problem is that the star ratings that are available freely on their website and to the IFAs that most people use are past performance driven. And as we've discussed, past performance is no guide to future performance. So the star ratings are almost useless. I say almost because they can be used as a first filter. But here's the thing. So for example, should we use it as a first filter? Should we do a quant filter first and then do qualitative filters? Or should we do it the other way around? Should we do qualitative research first, the clean sheet of paper, when we don't know what the performance is? And then once we formed our thesis, then go and check their performance. The two companies I worked for, one of them used the first method, second one used the second method. My point is the really large companies actually have two different philosophical approaches on how to do it. And that depends on their capabilities, on what they want to do. So I'm saying to you that fund manager research is not that simple. Now, other examples. Now, if you see a normal financial advisor, they'll tell you, oh, we look for a 3-year track record and we look for reasonable assets under management, because apparently these things are meant to be a good indicator of performance, of future performance. Turns out they are not. And this is what I'm saying to you. So here's an example of where somebody has gone and done the research of the assets under management of that asset class and tracked it and then looked at the outperformance. And basically, the longer you wait and the bigger the firm gets, the less the outperformance will be. So in fact, my old company, we used to have a sort of a simple saying that hire fund managers, AMCs, hire funds that you've never heard of and fire them as soon as they become famous. Now, that's what we do in an institutional setting. But what does your IFA do? They do the opposite. They actually tell you to put your money into funds that are reasonably high, good brand, and people have heard of, and they've been around for a while, and they have big AUMs and things like that. So like I said, research shows it's actually the opposite, which is why the fund return is much higher than the investor return. Google this. Morningstar has done a study where the average investor return is lower than the fund return. Why? Because most of the time they end up entering the fund way after the outperformance has already started coming down. So this is an example of how what people tell you is not based on research. They think it's common sense, but it's not. Similarly, and why does this AUM matter? It's not just the fact that they're early and want to impress you and then later they get tired. It's also a question of capacity. Capacity is the optimal level or the highest level of AUM that can be handled by that style without affecting outperformance. And it can be measured. It's a function of what stocks you buy and what the average traded volume is and so on. The point though is you need to have systems to do that. Most IFAs and most wealth firms do not do that. They simply, they kind of say, oh yeah, this XYZ fund, HDFC fund has become too big and we should start pulling money out. They say that without actually having studied it at what the capacity is. In a large cap fund, maybe it doesn't matter. So I see these arguments going, some IFA saying, oh, this fund has become too big. And then the fund manager says, no, but all the mutual funds put together are only X% of the market. And therefore we have not become too big. So we are fine. So the arguments happen, but both these arguments are not, neither of them are based on research. So I'm saying to you that it's not a simple thing to go and have these things actually research them and document them and share them. Same thing, there's actually a piece of research, again, you can Google this, on that outperformance is not positively correlated to better qualifications or IQ. Okay, so actually what matters in a fund manager is temperament. Temperament to be patient, to not panic. These are things that don't get measured by which school you went to. You went to Harvard or IIM Ahmedabad or whatever, or what IQ you have. Not that people publish their IQ, but anyway, the point is there are other things, and articulating a philosophy, an investment philosophy, is much more important. And also showing competitive advantages in how they generate ideas, how they make decisions, and how they manage risks is much, much more important. Same thing I told you, the CEO matters not just in terms of how forward thinking they are, what they're reinvesting, who they're owned by, can they stand up to their owners? And if the owners are asking, okay, you know what, we are owned by a bank and you are the AMC, so go and sell our product. Well, okay, what if it's not the right thing to do? So that is one. Also, employee compensation. Are their incentives aligned with what the investor wants? So there's a whole bunch of things that need to be studied. These are just some examples that I've put up here. That's not an exhaustive list. So now I'm going to end and stop here. And so the conclusion is this. Puri Ram Katha Khatam ho gayi. And basically the conclusion is this, that how to pick funds? The short answer is don't. Like, if you are a layperson, do not attempt to pick funds. Start with a passive index funds, ETFs, either index funds or ETFs, in equities. The split between your essentials foundation should be all in cash and money market funds. Your long-term portfolio should be all in equities. And then as you get closer to the goal, then you can start going into sort of growth and balanced, and then going further down. And then within 3 years of your goal being visible, then you switch into fixed interest and then cash. And then the high risk, high return could be venture capital funds, depending on how rich you are. If you are rich, then you should come and see me. I'm joking. If you are rich and you can buy AIFs, then certainly get an advisor. But here's the thing. Here's what you should do. If you have an advisor, if you don't have an advisor, please get one. If you do have an advisor, make them give you research, documented research on everything I've just said. If they're recommending any fund, they should back it up on a piece of paper, explaining what their own philosophy is of picking funds, as in what do they believe, how to research funds. Okay, so as a wealth firm or as an IFA, they must have an investment philosophy on what works in fund selection. And then they should have documented not just the fund that they are recommending, because to have done that, they needed to have done research on all the funds that are out there. to know that they have a competitive advantage, they must have at least checked out at least 15, 20 other funds in that asset class. Okay, so whatever you do, if you are going to go active, please make sure you have done research or your advisor has done research. If you're not going to go active or you don't want to do all of this, the easiest way to make money, at least for your growth pillars, is simply buy passive funds, ETFs. Okay, so on that note, this was education, not advice. I am not a licensed financial advisor and therefore cannot give you personal advice. So this was definitely education. And now I look forward to getting questions. And if you like this, then make sure you follow the Money Hunts. Thank you.
Perfect, ma'am. It was a great session. So let's read out some comments. So Dilip said, "Oh my God, you're posting too many myths in single session." And there's Vaibhavi saying session was too good. Tell us exactly how did you feel about the session. Manoj is saying, "Oh my God, session start research now. Awesome info." Stelish is saying liked so much. So perfect. You guys like it so much. So let's do one thing. Show us you liked it that much by clicking the link which I have sent you and subscribing to the Money Hunts channel. So that will help everyone and that will be a clear indication how good you liked the full session. All right, so let's directly go on to the question and answer sessions now. Ask me any questions. So what I will be doing, ma'am, I will be just picking some questions and I'll be asking you. Then you can go ahead and take the questions. All right, so we're open for questions now. All right, so Sanjay Sahu is asking, ETF investments are suggested for India or US?
Both. So for the, well, like I said, so you need to build your portfolio depending on how much time you have. And I said to you that everyone has a home bias. So ideally what you want is add US equities definitely to your Indian equities and then maybe add some more as well. But yeah, so you can buy the India Nifty 50 ETF. And then in the US, you can buy SPDR, which is the S&P 500. Start with that. Also, you can buy NASDAQ. And by the way, you don't even need to go to the US. You can buy them here. There are some, I think Motilal Oswal has the NASDAQ ETF that you can start with. And yes. I'm pretty sure, I thought I saw the S&P 500 as well.
Ma'am, I think there's a Mirai ETF. So that is being launched like a few months back only in June, July.
That's and that actually, I think, yeah.
That mimics the top 10, basically FANG stocks. So FANG stocks, top 10 stocks. And that is there.
Yeah. Okay. So I would say start with the large cap. So the Nifty 50 or the FANG, as you said. But at long-term portfolio, you should also diversify into small cap and technology and things like that, right? So not every company starts at the very top. So you definitely want to go down the spectrum of equities.
All right. So the next question is by Gautam. So is ICICI Prudential Technology Direct Plan good or bad for long term? How would you answer that, ma'am?
So, okay. So what are sector funds and thematic funds? I didn't touch on them. So for example, this one here says ICICI Prudential Technology, right? If the word technology or banking or financial services is mentioned in the fund name, that means it's a sector fund. That means that it only buys stocks that are in that sector, right? In that sector. So the company is only in that sector. Now, why would you want to limit yourself to one sector? You would only do that if you have strong conviction yourself that for some reason, that sector is going to outperform the other broader market, the other sectors. Now, my question to you would be, you need to know what that strong reason is. Why do you believe that to be the case? So if you think that, oh, COVID happened and therefore pharma stocks should do well. Yes, that's a great thinking. But here's the thing. Usually the market absorbs information like that very, very quickly. So if you are like, the market's already moved, everyone already knows there's COVID, everybody knows that Serum Institute is coming up with the vaccine, and then you go and say, oh, I'm going to buy that stock. Well, it's too late. It's built into the price. So understand there's a difference between the fundamentals and valuation. There's a difference between a good story and whether it's priced already into the price. Okay. Now, Warren Buffett says now that, yes, it's better to buy good fundamental businesses, even if the price is reasonably okay, because He can do that because his time horizon is long term. So if your time horizon is long term, then yes, if you think technology will do better than other sectors, then sure, you can buy a sector fund. Now, after that, whether it should be ICICI Prudential or whether it should be XYZ AMC, that I don't know. For that, you need to basically do everything I just said. You need to do that research on the AMC and say, why should ICICI Prudential do better? Do they have better technology analysts? I mean, that's the only reason I can think of. How do you know? Do you know the technology analyst there? Do you know if he or she has got a better track record? Why would they? Now, if you're buying the ETF, on the other hand, you can buy sector ETFs also. So there you don't have to pick which manager is going to do better. You simply have to have a view on that sector. A thematic ETF, by the way, works on the same principle. So for example, there's a whole bunch of them coming out which have the ESG theme, environmental, social, and governance. Okay, they could have an India shining theme. They could have a India export theme. These are themes that cut across multiple sectors, maybe not as wide as all sectors, but maybe 2 or 3 sectors. But again, when you start doing these whether it's a sector or a theme, you are taking a top-down sector macro view on what is going to do better. I'm just telling you that research shows when we have studied fund managers, professional people whose job it is to go and pick stocks and study macro. When we have studied it, turns out fund managers whose full-time job it is are not as good in top-down macro themes as they are in bottom-up stock picking. So imagine. So I'm saying to you that before you start doing it yourself, just have a little humility that people whose full-time job it is haven't done a good job over the long run. So I think here's the other thing. In stock picking, there are 3 ways to add value, or in any investment, there's only 3 ways to add value. You either have better information, or you have the same information, but you do better analysis, or you have the same information and analysis, but your own behavior is better. Here's what I'm saying to you. If you are doing this part-time or your students, I'm not saying you can't do better analysis, you can, but I'm saying to you, the chances of you doing it is pretty low, okay, compared to AMCs who have everything at their disposal. So the only thing that you have that the fund manager doesn't have is time on your hand, long runway, because you're young, because you're not running a fund for somebody else. You don't have to sell just because there's a run on your fund. What you have is what they don't have, the luxury of being invested for the very long term. So that book that you have in the back, Aditya, that Psychology of Money, that is what that book teaches you as well, that you have the temperament, the long-term patience. Exactly. So what you need to do is, investing is a fun profession, but you need to learn over time and you need to work on yourself. In fact, there's research apparently that shows that people who do meditation, for example, become better investors over long run because they don't panic as much. So what I'm saying is you can do that with your thing, but don't assume that you have some major insight that somehow every other fund manager in the world missed.
Correct. Makes sense. Very well answered, ma'am. Very well answered. Now, the next question is a very interesting one. So this is by Ritvik, and he asked, how important is AUM for an ETF or a mutual fund with respect to liquidity?
It's not. So there are 2 different things. So firstly, for active and passive, there are 2 different issues. Liquidity. So there's a whole, so remember I told you I have this other business as well. So go to moneymanagementindia.net. Okay. If some of you are online, just go and look at it right now, moneymanagementindia.net. And on the homepage itself, there's an article called ETF liquidity. Okay. Where I discussed with an ETF expert, a guy called Anubhav Srivastav, where we discussed this very issue. So the first question is, what is liquidity? Okay, what do you mean by that? Is it the buy sell ask? Is it the discount to NAV? Is it the volume? Is it what is it that you're asking? And then we looked at the ETF liquidity. A lot of people have this belief that, this particular ETF is not liquid because, and then there's, it's going to be traded at a huge discount to NAV. Well, that's not possible. because they are market makers and there's authorized participants. If the discount to NAV becomes too much, then somebody will step in and arbitrage it away. Okay, it's just that they're small amounts, so they might not bother. But if it becomes big enough, so unless you happen to be, and you as a retail investor, frankly, shouldn't care. Liquidity should be the least of your concerns because you're investing for the long run anyway. In fact, the reason venture capital and private equity and all these other things give higher returns than listed equity is because they get paid for the illiquidity premium. My point is, around the world, the world is moving from liquid assets to illiquid assets, from liquid to unlisted or private assets, to actually get paid for the illiquidity. So what I'm saying to you is, don't assume that illiquidity is bad. Okay, you can get paid for it, especially if you have time horizon. But answering your question, on ETFs, I wouldn't worry too much about it. Having said that, within ETFs, don't assume all ETFs are the same. They're not. Some of them end up having a higher tracking error. So that's what you should be worried about rather than liquidity. In terms of size, that's where I think ETFs, if they're too small, it may well be that is the problem. Because they're too small and therefore there's not market makers and there's no APs and whatever, that's why they are illiquid. But it shouldn't matter. You can still redeem your thing in specie eventually if you're big enough.
Correct. So I think that was an important point, that tracking error is important in ETFs. I think this is something which I will also take home. All right. So the next question is by Veena Agarwal. And she asks, investing in direct mutual fund is better or going through regular mutual funds through a professional person who advises you? I think this is an interesting question.
Yes, it is. Sorry, I completely forgot to mention that. Well, partly because I concluded you should go passive anyway. I guess that means forget act direct or regular. I mean, you should go passive, which means they should go direct, which means it's cheapest, right? You shouldn't have to pay someone to go and select funds for you.
Correct.
If you're going to go active, then depends. Now, if you are going to ask your advisor to help you select the fund, then he or she is doing some work for you. Then you should pay them, right? Now, whether you pay them through the regular plan via commissions, or whether you pay them as a separate advisory fee and then get them to put you into a direct fund, in the early years, it doesn't matter, right? Either way, you're paying them, whether directly or indirectly.
Correct.
But I think even there, direct is probably better, because when the guy or person has done the research upfront, they've done it one time. You pay them that one time, and then you get the direct unit, and then you let the direct unit run for the rest of your life, right? Hopefully, on average, at least 5, 6, 7 years, you should not be able to change the fund. You should not. In fact, my pension account is sitting in a fund that I've not changed ever. It's been running for the last 15 years.
That's
okay.
interesting.
So what I'm saying to you that you should not need to change your active funds, because every time you change, you trigger a tax event. You pay someone again. So are you confident that whatever they're picking for you are so good, the funds are so good, that you shouldn't change them for 5, 7 years at least?
Correct.
Your horizon is 20, 30, 40 years, right? Ideally, you want to disrupt and change as few times as possible. Now, absolutely something changes, sure, change it. An AMC gets taken over, something happens, whatever. But by and large, you shouldn't have to.
Right. I think, ma'am, this is also a very interesting thing. Why? Because there is a particular application. Of course, I won't name it right now, but it was a very popular application, and it actually recommended the investors to actually rebalance their portfolio every 1 year with some different, let's say, some different mutual funds, or sell a particular mutual fund they always or they had and replace it with someone else. So I think this is a very important point.
No. So the word rebalance in our dictionary is rebalance means bringing the asset allocation back to what you intended to be. So if you started with 60-40, 60 in equity and 40 in bonds, you once a year, you can rebalance it back to 60-40. That is a good thing.
Correct.
The other rebalance, which is basically changing your mutual funds. I want to use a Deepika line. Can I use it? Can I be stupid and say,
yeah, sure.
कहाँ से खरीदी ये बकवास dictionary? Okay, ये rebalance का definition का मतलब ही बदल दिया है. That's not good. Okay, don't let anyone tell you that you should change mutual funds every year. Okay, BS. Do not do it.
Correct. I think that's a great advice. So next question is by Aditya Tagi. And he says, what about investment in small cases as compared to mutual funds?
So what are small cases? Small cases or wealth baskets. Okay. There are two brand names there. So a small case or a wealth basket is not a noun. I mean, it's a proper noun. Okay. It's not like a PMS. Okay. So what are these? They're basically, they are like PMSs in that they are bundling a selection of stocks. It could be in a theme, it could be in a sector, or it could be by a style. Okay. It could be one of the three. So they're, in a way, they're like a mutual fund. Okay. You are hiring somebody, a registered investment advisor or a PMS licensee, to pick some stocks for you. And the stocks are being bought in your name. Okay. So they're like a PMS in that respect. It's just that the amounts are much smaller and they are more likely to be not hand-picked by qualitative means, but they're likely to be picked through a quant process. That's not bad in itself. Not at all. But you definitely want to research them as if they are a mutual fund. You want to do some research on why do they use this measure or that measure or whatever it is. Whatever they're applying to that stock picking, you might want to ask them what that is. And again, there's not enough research on them. But by itself, the structure is like a PMS. The stocks are being held in your name and being rebalanced.
All right, makes sense. So is it better for a person to actually go for that instead of mutual funds? Because I feel small cases, the commission structure is like very low basically as compared to mutual funds.
Buy passive. I mean, what is wrong with that? Just puri dam katha khatam ho gayi. Just buy passive. Okay. Start collecting your beta first. Okay. Don't worry about the alpha, which is tiny compared to what you're going to get beta. Now, small cases in wealth baskets, yes, chances are that they will do better because you are at least not hampered by AUM, for example, assets under management or size or fund manager. But like I said, you still have to learn to research why they selected that basket. Right now, because they've been only going for a couple of years and the market has been very hot, I don't know that they've actually seen a downturn yet to be able to judge them that well. Now, having said all of this, some of them are tying up with very well-regarded professional fund managers. So, for example, I saw Sunil Singhania, who used to be the fund manager at Reliance and now has his own PMS called Abacus. And then there's a whole bunch of them. Okay, even Anubhav Srivastava, who I mentioned, ETF one, he has a wealth basket with Wealth Desk portfolio of ETFs. Okay, so if you liked what I just said, you can buy his recommended portfolio of ETFs, where he will recommend what proportion of ETFs in what risk profile, and they will rebalance it for you. So literally, you have to do nothing. You just get told that, oh, this Nifty 50 is being sold, and this one is being bought, and this one is whatever. So in a way, I'm saying yes, I agree with you. The wealth basket in small cases are a good idea, but you still have to figure out why you're buying that particular one and does it meet your needs. So Correct. It can be active or passive.
Makes sense. Generally stick to passive only if you're watching it, and passive is the best way to go. Yes. All right. So what we'll do is we'll take the last question for today. And this question, and I think this is an interesting question. A few world indices ETF have higher expense ratio than mutual funds? In that case, what to do, and how can we use expense ratio to choose ETFs, or how does that affect our study?
Okay, I'm lost. You're saying the ETFs had higher expense ratio than active mutual funds?
Correct. According to Aishwarya M. So she's saying that there are some world indices ETF who have higher expense ratio than mutual funds.
No, they're not high expense ratios than the corresponding mutual fund. Now, if you compare an emerging market ETF, index ETF, with a India only active mutual fund, then you're comparing apples and oranges. You have to compare the passive ETF to the active mutual fund in that asset class itself. Okay. Now, why are some ETFs more expensive than others? Because obviously, the transaction costs. So when you are dealing with one country, okay, in India, buying an ETF is sub 10 basis points. In fact, the Spider ETF I was telling you in US is like 4 basis points, like literally 0.04. Okay. So you can buy ETFs in a single country for very, very cheap, because in that country, someone can track it very cheaply. However, when you start going and buying a world or a region, then somebody has to go and put it together. And there are license fees being paid to the ETF, the index provider, and then the assembly. Oh, by the way, so just FYI, so if you study ETFs, in India, they're done on full replication. So they have to buy all the stocks that are in the index. So if the Nifty 50 ETF, they have to buy all 50 stocks. Whereas in other markets, they do it through sampling techniques, which means that they don't have to buy all the stocks. They can buy just a sample that they predict will match the return. So that's why things like Vanguard and Barclays and State Street are considered global leaders, because they've mastered those techniques.
Makes sense.